This is not a once in a 50-year currency reset. This is like a 1 in 400-year currency crisis that's so well known that it'll be generations before it's forgotten. The demand for industrial silver, the 1,000-ounce bars, is at a level that I have never seen before. And it's causing, in my view, or one of the main causes, to see a significant rise in the silver price.
David Morgan says silver has entered the final acceleration phase of a historic bull market. Industrial demand for 1,000-ounce bars is exploding. Inventories are draining, and annual deficits exceed 200 million ounces. With a once-in-400-year currency crisis unfolding, Morgan expects silver to surge past $60 and potentially $100 plus as panic-driven demand hits and the global monetary system resets. Thanks for watching. Subscribe to Fine Metal for more updates.
Well, there's one is the arbitrage I just mentioned. That's a data point that you can point to as a fact. The other one is less notable, but certainly there as a fact. That is that silver became a critical mineral recently for the United States. Critical really means strategic, and it was used basically for something that you have to have, especially in a strategic sense, meaning militarily. The strategic stockpile before it was turned into silver eagles and sent out to the U.S. Treasury to mint was 139 million ounces. So if we go back to that kind of a level over the next few years, that's a further demand on the silver pile that exists that's shrinking year over year. So that's one. The other one is India has become much more into the silver market. They always have been, but of late they have been very, very large purchasers of silver. In fact, they have a similar ETF to what we know as the SLV or PSLV, where it's physically backed by silver, and they cannot actually get the amount of physical they want at this time to back up new shares of their ETF. That can be pointed to as a fact. Another one is Russia has bought into silver, not necessarily from a monetary perspective, but from a strategic asset perspective. And I would say that would be another one. And you can also look at the Saudis bought about 1 million shares of the SLV recently. And of course, that sounds like a lot for you and I, but for them, I mean, 1 million shares is not very much. But nonetheless, it does show that there is a nation state willing to take a stake in silver. And that is not a first, but it's a first in this bull market. And lastly, I would say that the inability to have the silver get to the right place at the right time, that's more of a logistics problem, but yet it seems to be occurring more and more. It's sort of like a shuffling the pea between the shells. Where is it? Who needs it? Where's it going to go? And that's probably a good analogy for where I see the market curve. Well, all markets move at the margin, as you know, and the margin for silver is at the monetary demand. But the industrial demand has gone up very, very rapidly. In the last 25 years, which sounds like a lot, but in human terms, but in monetary terms, it's nothing. So if you go back 25 years ago, 35% of the market was industrial demand. And at that time, we only mined 550 million ounces on an annual basis. Today, industrial demand is probably pushing 70%, and we mine 850 million ounces now. So think about that. The amount of demand 25 years ago was 30 of 50, so maybe 250 million ounces. Now, 70% of 9 is like 600 million ounces. So that doesn't go away. Now, in a big recession or a global contraction, it could mitigate it somewhat, but not that much really. Now, the calling card is the monetary demand, and that's where the retail has backed off. I just checked again today with a couple of the big wholesalers, and they're still buying back more silver from retail than they're selling. But bigger institutions, as you outlined, Michelle, are buying silver for monetary purposes. And the industrial demand, I think, is where I've talked about for years, which means when that point in time happens, where industry and monetary demand come together at the same time, we are going to see an explosion in the silver price. And it's basically more industrial right now, I'd say, than monetary, at least from the retail side. but both demands are there and accelerate. We have had a structural deficit in the silver market, according to Metals Focus, the Silver Institute, and many other bullion banks, stating that in the last 4 years, maybe 5, we've had a structural deficit somewhere around the 200 million ounces per year level. And that's now open knowledge. And so the way supply and demand balances is the fact that we have an above ground stockpile of silver, and to make up the difference between what's mined and recycled, we take from that stockpile and make the supply and demand balance. But that can only go on for so long. And right now, according to one of the leading experts in metals markets as an independent, such as myself, Matt Watson, has produced a graph or a chart going out the next 25 years where we see the structural deficit getting bigger and bigger and bigger. So in theory, let me say it again, Michelle, in theory, you could eat up the above ground silver supply over the next few years if and only if everything stayed status quo. In other words, the recycling stayed the same, the mining stayed the same, and the demand stayed the same. But that is fairly likely. And because of that fact, any added demand, such as monetary demand, could accelerate what we've already seen as a mass acceleration in the past few days. Again, I'll repeat myself, but it bears repeating. When you've got industry needing silver at any price and monetary demand because of debasement of the currencies getting into the final chapter, you have a dual demand that no other commodity actually has to the level that silver does. Well, first of all, the military demand on silver is not broken out in either the surveys. The Silver Yearbook or what CPM Group does, they just put it into the overall picture, and that's fine. That's really not an open secret. Well, first of all, let me state for factual accuracy, I don't know exactly. However, the cooling system that they purportedly failed has a redundancy of like 2 or 3. I mean, it's a financial market that needs to be up, and it wasn't just silver that failed. It was a lot of derivatives that were unable to be traded in that 10, 11-hour time frame. I think someone pulled the plug is what I think. Can I prove it? No. But it's highly unlikely that the redundancy, the way that system is built, wouldn't kick in something else and keep that cooling system going. So I don't really buy the official story. I also have to look back in the history, Michelle, see all the times, for example, the head of the CFTC comes out and literally says in the public that we need to tamp down the silver market. I mean, these are supposed to be objective realities, and his job is pretty much well known in the public domain that they're supposed to be a fair, free, and open market. And yet he has the ability to tell everyone they need to tamp down the silver. And that's one example of several. Not too many come right to my head at this moment in time. But there's been a lot of interesting things around the silver market for decades, and other markets as well. I'm not trying to single out silver. It's just that silver gets a lot of attention. So on that basis, I'll just leave it there. I've made my case of what I think. It isn't a surprise that after things got back to normal, we saw silver still continued higher, but we also know on the rollover going from the December, the current month, out into the future, on that last rollover, there were a lot of contracts that did not roll over, meaning that the professionals were not wanting to take the amount of risk that they had until they made the roll. In other words, if I had X amount and I decreased it by about 1/3, which happened in a couple of cases, that means the risk that they have subdued it substantially. And that makes sense, because if you're short in this market with what we're talking about, I would reconsider that position. The one that does stand up for silver is none other than Warren Buffett. And we have to recall that Warren Buffett bought 130 million ounces of silver off the COMEX in 1999. And when he declared it on his form for the year for Berkshire Hathaway, the word silver never actually appeared in the report. It was under the miscellaneous category, Michelle, because by law, if anything you have in your portfolio is less than 2% of your holdings, you could list it as a miscellaneous investment. And that's exactly what Berkshire Hathaway did when they bought that. But let's look at the other side of the coin. 129.7, million ounces of silver purchased off the COMEX put quite a dent in the COMEX silver supply physically in that year. And they only delivered him about 90 million ounces, and the other 40 million ounces they basically got over time. It spiked the lease rate in silver and it stayed high for quite some time. So even though it was a small amount for Berkshire Hathaway, less than 2%, from the perspective of the physical silver supply, it was quite a punch, as I said earlier, into the COMEX inventory. So silver is a very small market. Probably known as one of the best investors of all time. Certainly hates gold but loves silver. Very seldom does anyone ever put the microphone in front of him and say, you badmouth gold very often, Mr. Buffett, but why do you keep buying silver? But I know why he likes silver. But I'll keep that to myself so we can talk about it on our next show.
I'm going to have to ask you now, why does Buffett like silver?
No, I really don't know. I think it has to do with the supply-demand dynamics are so intriguing. It's such a small market that any one large purchase could certainly disrupt the market. When he bought in 99 and confessed it was him, the price went from $5 to $8 literally overnight. So $3 on a 5, that's a pretty big move. It didn't double, but quite a healthy move. It came right back down into the 5s. But once that announcement was made, you got a $3 move on a $5 price. Again, that's a large percentage gain. Longer term, I do still think we're in the acceleration phase. So if we top out in a year and a half or two, I don't know. I mean, I'm on record in 2003 putting in writing that I saw $100 silver this time. And that was when silver was at $5 or a little under that. So I was looking for a 20-fold increase from the year 2003 to wherever it ends. I don't know. Price predictions are so difficult because there's so much funny money out there that might be seeking a safe haven that's really hard to anticipate or calculate. But I do think when the mainstream media puts me back on CNBC, you might be consider selling some of your silver holdings. But I would say on gold, I think 5,000's a gimme. I think it'll make it to at least that level. Could it make it to 10? Yes. Could it make it to 20? Yes.
In what time frame?
Oh, I'm still looking at, near term. I'm looking at acceleration phase. I mean, you may have heard me. I don't know how much of my podcast you've heard. I'm sure you're very busy, but I've said over and over again that 90% of the move comes in the last 10% of the time. Mm-hmm. So if that's true, and this market started in 2000, we're in 2025, what's 10% of 25 years? 2.5. And if that's 90% of the move, and that's not an exact term, but it's the idea of the acceleration. Look at how long it took to go from $2,000 gold to $4,400. Look at how long it took to go from $30 silver to $60 silver. Not long. If that trend continues, and I'm suggesting that it will, we could be getting to the top here very soon, especially with what I wrote in the editorial that I sent you. We're at a point where the Fed is basically losing its power. It's becoming more and more powerless over the financial markets. And the markets themselves are valuing what the US dollar is worth today, tomorrow, what its collateral abilities are, and how much do you have to have the banks of last resort, the Fed, buy back bonds, notes, and bills that no one else wants.
So in that landscape, we're seeing that 10% move, the remaining 10% move happening in the next 2.5 years?
Yeah, 90% of the move in the
90% of the move. Okay, so that's, so that's when the real dramatic acceleration kicks in. So what is that? Is that $10,000 gold? What does that look like?
Well, what it could look like if you go from, let's say, the breakout at 2,000, if you took a factor of 5, you look at $10,000 gold over the next couple of years. Well, there's a 3-word sentence I use all the time, Michelle, and that's all fiat fails. So all recorded history has substantiated the fact that any currency that's unbacked fails at some point. It doesn't mean necessarily goes to absolute zero, but it does mean it's replaced, either with coming back to a gold standard, or coming back to a bimetallic standard, or reissuing a currency, turning in 10 old notes for one new one, or that type of thing. We've never seen it in an advanced economy like we have in the United States, where basically our debt market is considered to be the sacred situation for all monetary aspects. In other words, the T-bill, T-bond, T-note market is so important and so well trusted that the whole system relies upon it. And yet that's starting to fail now. So the bankers know, anyone that studies, what you and I talk about understands that we're at a mathematical impossibility to be able to pay off the debt. And we're getting to a point where it's going to be more and more difficult to just pay the interest on the debt. And what that requires, it's what it's always required. That means a new system, which means, are we going to move to a CBDC or something similar? And the answer is most likely yes. And the time is short because we are in a situation where the Fed, as I wrote in the last editorial, cannot do anything correct at this point. If they try and lower interest rates and weaken the dollar, which is their motive, it may not work because the market itself will take precedence and say, I don't trust your T-bill or T-bond like I used to. In order for me to be the sucker to hold on to it much longer, you have got to pay me more in interest, because I think the debasement of the currency is built into the cake and I need to be compensated. So they could be in a situation where it's already manifest, where they lower interest rates, but the 10-year note doesn't budge. And that's the problem they face. So no matter what they do, they're basically out of control from what they have had in the past. And once that takes place and the market starts to take control, which it has and will continue in my view, then you will see a bigger motivation than ever to reset the system in one way or another. Well, at the very top, it's manic panic. It's a manic situation. There's no fever like gold fever, the run to gold, as good as gold. I have to save myself. My pension's not there. Haven't saved enough for retirement, whatever it is. There's all kinds of motivators, but they're mostly fear-driven, as we spoke about earlier. Mm-hmm. And I need to look out after myself. I mean, people basically, human nature, from my perspective, are somewhat selfish. And I think this is built into our DNA. We have to survive. We need to eat, have shelter, all those things. And that doesn't necessarily make it wrong. Having some self-interest, I think, is a natural thing. And I think it's needed. But when it goes overboard, that's when you get into this problem.